Hello, everybody. How are you doing? Good afternoon to all. I hope you can see everything fine. We're going to be starting our webinar in just a second. The topic of today's webinar is a married put and a caller. And some people ask me, what on earth is this about? I mean, they really thought, what are we dealing with here? Well, it's nothing unusual. It's just different ways that you can protect yourself. And like many other things, there's always a chance that things do not work well. So let's see what we're going to do. So the first thing I need to do is to uh, get the first slide, which obviously didn't go through. And the first slide, since we're going to be talking about married puts and collars, these are basically option strategies. And the options are derivatives, and some people think derivatives are very, very scary and dangerous. They can be if you misuse them. So let's talk about the disclaimer, which is very important to note right up front. First of all, Robert Bull, I am not an investment advisor. I'm not an attorney, a CPA, an accountant, or financial advisor. And you agree that you bear responsibility for your investment, financial, and tax decisions. You agree that that Robert Bull, me, is not and will not be liable for any investment, financial, or tax decision that you may make based upon the materials that will be presented. All information is sourced from various publications that I believe are accurate and reliable. However, there's no claims or representations as to their accuracy, completeness, or truth of the material contained in the following presentation. Please consult your own attorney, your tax advisor, accountant, real estate broker, whatever the case may be. Stocks and options trading have large potential rewards, but also large potential risks. You must be aware of these risks and be willing to accept them in order to invest in stocks or option markets. Please do not trade with money you cannot afford to lose. And this, what we're talking today, is neither an offer to buy or sell or a recommendation of any particular stock or options. It's just simply educational, and that's the sole purpose of what we're trying to do here, okay? So let's make sure that we're very clear on that and that everybody feels comfortable as we move forward. So let's briefly go over two little subjects that we discussed last time. And I say little because they're very important to know. One is what are call and put options, okay? A put option is a contract giving the owner, the person who buys the put contract, the right, but not the obligation, the right. When you buy something, you have a right to sell the underlying security at a predetermined price within a specific time. What does that mean? Let's just say I buy a July put option. I buy it at, let's say, $150. Just invent a number. And the stock today is trading at 180. And it goes down to 150 before July. It goes down in June. Guess what? I have the right to put it to you. In other words, to sell it to you, okay? I have the right. It doesn't mean I will, because wait, I could go to July. Let's see. Well, in July, if it goes above 150, obviously I'm not going to make you buy it at 150 because I have it or I'll be responsible for it. So that'd be silly for me to sell it you at 150 if the market's at 160, okay? So a put contract gives the buyer, the owner of the put, the right, but not the obligation to put the contract to you, to sell the contract to you, to exercise their right, okay? A call option is exactly the opposite. A call option gives me the right to buy the contract, okay? I'm going to buy a call. I have the right to buy it. If I sell a call, I have an obligation to sell it at that price, okay? But when I buy it, I have a right, not an obligation, okay? And when we buy it, it's the underlying security within a specific period of time. I use the month of July just as an example. Puts and calls, depending on the company that you're dealing with or the index that you're dealing with or whatever equity you're talking about, they can go out even 2 years out. Not everybody does because companies that are not widely traded are not going to go out that far. And some companies are traded on a weekly basis. So you have a whole different time frames that you can deal with. Now, why on earth would you deal with options, trading options in general? Why would you bother? Number one, it gives you leverage. One contract equals 100 shares. So if you buy one contract of Apple, it gives you control over 100 shares of Apple. If you bought a call, it gives you the right to buy. And if I bought a put, it gives me the right to sell it. On the other hand, if I sold a call, I have an obligation to give it to you when you want it because you have the right, okay? All right, so these are very important things. Another thing, options can be a protection. They can be like insurance on a stock, and that's what we're going to be talking about later on. The other thing we can do with options, we can pay for the protection. What do I mean by that? We can buy a put, sell a call to reduce the total cost, okay? The other thing potentially we could do is have income streams, but we're not going to get into that topic today. Income streams basically mean selling options, and we're not covering that at all today. All right. So let's talk about long stocks. When we talk about being long on a stock, it means you own the stock. You bought it, you own it of a company. Okay. So when you're going to go long on any stock, when you're going to decide if you want to buy something, you have to have some kind of perspective, some kind of forecast as to the direction of the market, the sector that you're in. It could be, I don't know, fast-moving foods. It could be what they call discretionary products. It could be tourism. It could be transportation. It could be technology. It could be anything possible, the type of sector. And even with the sector, we have to have a perspective on the company, okay? And that perspective, hopefully you'll get that from looking at charts, looking at analysis. Don't listen to the talking heads all the time because they change day by day, okay? They may give you some kind of perspective, but you need to figure out how to develop your own. I recommend you learn how to look at charts and you get an idea of trends, etc. But there's always things that come out of nowhere. We talked the other day about black swans. A black swan is something that comes out of nowhere. Nobody even dreamt it would happen. It was just, wow, my God, how did that happen? Well, there it came. Now look at the problems we're in, okay? So black swans are something that are unpredictable things. So once we decide that we have a feeling of where the market's going to go, the sector and the company, we then must identify and analyze potential candidates for investments. Okay, we're not just going to throw a dartboard. We're going to look at different companies and come up with an idea. So right now, for the case of this webinar, and this is only an example, and all the material I'm going to show you today, I looked up this morning, and as I was going through downloading the different slides that I was looking at on a trading platform and putting them into this PowerPoint, things are changing because things change every minute the market's open. In fact, they even change when the market is not open, because when the market's not open, it's called after hours. Okay, and there are after hour trades, but that's a different story altogether. But in this case, for today's webinar, let's assume that you're nervous, okay? But you believe the market, and more importantly, the sector you're dealing with is going to continue to grow. So let's look at some candidates within the technology sector, okay? We think technology is really cool. Remember, this is all hypothetical. This is not my opinion. Okay, I'm just using an example. Okay, so please consider this as examples, not as recommendations, all right? So let's look at one that many people like. It's called Apple. Okay, Apple computer. Oh my gosh, if you'd only bought it many, many years ago, $1.50 a share, whatever it is. Okay, so let's just say we want to look at Apple, and let's just say the only thing we have is a trading platform. This is a trading platform that I took from here from TD Ameritrade. You can look at any Schwab, whatever. They all look very similar. Okay. So when you look at Apple, you pull Apple up, it'll tell you different things. And let's just see what this tells me. First of all, I want to make sure we're talking about Apple. And that's why I have it circled up there, Apple in green, because, there could be other symbols that are similar. What is the symbol of Apple? If you don't know it, it'll look it up. You can write the name of the company. It'll give you different options. You got to choose the right one, okay? So in this case, Apple this morning was trading at $314.24 for one share. $300 for one simple share, okay? And by the way, it was up $2.82, up by 1 percentage point, and that was this morning, all right? Okay, fine. Well, what else can I look at in the charts that they show me? Well, one of the things I like to look at is something that's right here, okay? It tells me what is the EPS, the earnings per share. Is this company making money, and what kind of earnings is it generating, okay? And when we talk about earnings per share, it's important because if a company is not making money, it has to have other reasons it's selling. The other thing is if it's making money, it can pay you a dividend. And over here, if you notice here, it says here, I'm looking at the wrong chart, I'm sorry. It says it pays $3.28, which means 1%. 1% of what? It's 1% of the price. If you look at the price and you look at 1.05, it's going to give you a yield of $3.28 a year. Okay, they pay out every quarter. Okay, but that's your annual yield, 1%. Now, what it tells you, since the company is making $12 a share, it is paying out $3 a share. So basically, where's the rest of the money? Well, it's kept within the company. It's something called retained earnings. The company will want that money for their other investments, their marketing, their development, whatever they're doing. They're not going to give all their profits away. Every company has a different perspective in terms of what are they going to do with their profits on the assumption that they have profits. And given today's economy, those companies who do not have retained earnings on their balance sheets, in other words, they didn't keep the profits in a little cookie jar for a dangerous time, they're in deep trouble, okay? If you just saw, J.C. Penney's is going to file for bankruptcy protection. Neiman Marcus is filing for bankruptcy protection. J. Crew is filing. There's a whole bunch of companies that are in deep, deep trouble. Why? They didn't have cash. They could have had what we call current assets. They could have had a lot of inventory. Imagine a company like Macy's. Macy's, and I just looked at their balance sheet not too long ago. I think it was last week. They had $5 billion in inventory. Well, that doesn't do them any good. Macy's is shut. So that $5 billion, it's within their system. They can't sell it. And it's been 2 months. And what if they don't open until the end of June? Well, the end of June is already in the middle of summer. 2 months ago is the middle of spring. Can you convert that into cash? No. If you owe money, what does that mean? You can't convert the inventory into money. Okay? And even if you could convert inventory into money, can you get rid of it really quick? So that's a different question. Altogether, I deviated totally. So anyway, it shows me that it's paying $3. It tells me when the dividend was. Why do I want to know the dividend date? Because ex-dividend is when you own the company. It goes ex-dividend, means the people who own the stock on that date, which is May 8th, they're going to get the dividend. If you bought the stock May 9th, you won't. But if you have a high-yielding company like these, like the utility companies that pay a really good dividend, the day after the dividend, the price goes down. Why? Because you're not going to get the dividend. The day before, those people are going to get the dividend. So you have to really watch that a little bit, okay? And it tells you when you're going to get paid, but frankly, it's meaningless. It does meaningless in the sense if you're going to sell it, it doesn't matter. You're still going to get paid, okay? The other interesting number is something here called right over here. Okay, you see that there? That's called a PE ratio. It tells you price earnings. Since this company is making $12, sorry, $24, excuse me. No, the PE is 24, so it's 24 times the earnings is the 300, okay? I'm sorry, I don't have my right glasses on. So the PE ratio is 24, the earnings is 12. So 24 times 12 equals this number here, okay? But we want to know the PE ratio. Companies that are growing very fast tend to have big PE ratios. Companies that are losing money, not making money, depending, could have a low PE ratio. They could have a very high PE ratio. The question is, if they're not making money, are they growing a lot? Amazon, and I didn't put Amazon up because it's so expensive. Amazon for years lost money, but it had tremendous price. And once it started making money, made a very little bit of money. It had a huge PE ratio, okay? So this price earnings ratio. The other thing that this little chart shows us is, look at this. It shows us a trend over the last year. Okay, that's right here. I chose 1 year. I don't know why, no real reason why. And you see, okay, it topped up over here when the market was doing really great. It crashed and it came back up. And it's almost to where it was before. So what we know right now it's been trending up, it's near the top of its range. Okay, that's interesting. Let's look at another one. Let's look at Twitter. And I chose Twitter because our dear president loves to tweet. Okay, and I thought, well, maybe Twitter has a good price, whatever. I have no idea. So here we see the price of Twitter. 29 bucks, 32 cents. It went up today just 17 cents, up 0.58, less than Apple. Is that good, bad? I don't know. I don't know what to tell you. One thing is interesting, which I don't know if I showed it to you in the Apple one. Yeah, I did. Apple one shows me the range. I skipped it. I was there between what it was being the low in the last 52 weeks and where it is right now. So right now it's really close to the high of the last year. Is that bad or good? It depends. Just because it's close to the high doesn't mean it couldn't go higher. Keep on going higher. Okay. In the case of our friends at Twitter, we see a little problem here because it's towards the low range of the high of the last 52 weeks. Okay. Let's have a look at some other little numbers here, okay? What are the earnings per share? $1.62. Not too bad, but guess what? They don't pay any dividends. So they should have a truckload of cash somewhere, or they're investing that earnings into other platforms, other systems. We don't know, okay? We'd have to go further, deeper, but we don't have that on this little chart, okay? But the PE ratio is 18, which is lower than our friends in Apple, okay? And if we look at what's going on, and here I only did a shorter chart. I'm sorry about that. I did 6 months, but still, we know it went up and then it crashed and it's kind of over here. And we're looking at staying at the low end of the range, just as it shows here. So it's really not going anywhere great. So unless we think that this is going to really go back up to where it was over there, but we're seeing here it's kind of hanging around there. So don't want to make any recommendations. We're just using this as a case study, okay? So let's look at another one. A lot of people today are using Zoom, 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 Zoom. So let's look at Zoom, okay? Why not? Zoom, that's a lot of fun, okay? And Zoom circled up there, okay? What's the price? 168 bucks. All right, cool. Where is it? It's on the high end. Look at what it did. It went all the way up. Yeah, it's had this pullback like everybody else, but it's, wow, it's reaching its all-time high. Could it keep on going? Maybe. Why not? Okay. Is it making any money? 9 pennies. 9 pennies earnings per share? Wow. What is the PE ratio, price compared to the earnings? So if we take this price of $168 and we divide it by 9 cents, it will tell us that it's selling at a PE ratio of 1,846. So take 1,846 and multiply that by 9 pennies, you're going to get $168, almost $169. That's a huge PE ratio. Huge, huge, huge. Remember, Apple's at 24. This is at 1,800. So people are expecting one or two things to happen, or maybe both. They're expecting the earnings. Let me rephrase that. They're expecting the sales to continue to grow because everybody's going to be using Zoom and Zoom and Zoom and Zoom and Zoom. And they're expecting this company to become profitable, very profitable. If those two things happen, the PE ratio will go down. Why? Because if this company starts making $10, let's just say it's making $10. $10 on 160 is roughly about 6%. Okay? Well, that's kind of okay, whatever. So we just don't know where it is, what's going to be happening, but we do know that the market sees this company extremely favorably because it's selling at a PE ratio that is very, very high, very high. Is that good or bad? Doesn't matter. It's good if it's going up and you own it. It's bad if you own it and it goes down. Uh-oh. So what do we do? Well, let's have a look at what we can do. Okay. The first thing we're going to do is let's have a look. Let's just say, hey, let's have a look at Apple. What's going to happen if we buy Apple? Okay. So we'll go to the buying platform and see what we can do. And here's what we have to look at. The first thing is when we want to do this, we want to put in a buy order. We got to put the word buy, make sure we put in the word buy. We want to have 100 shares. I always try to do my best to buy everything in multiples of 100. It gives me flexibility in terms of options and trades and things. So 100 is the number I like. I make sure I put in the symbol. You see it right there, AAPL. That's the symbol for Apple. And the moment I do that, it's going to give me this little chart over here, which is really cool. This little chart's going to give me some other things, all right? Okay, having seen that, what can I do? Okay, so, okay, what can I do now? Okay, well, I can say, let me place an order, okay, just to see what it'll look like, all right? And yeah, I may think this is really cool. So I'm going to place an order. I'm going to say, I'll buy, I said, I'm going to buy 100 Apple. I'm going to buy it at the market. And when I click that word market, it gives me a few other options. One of them is a limit, which means I won't pay more than this amount. Another one is a stop market that goes down. Another one's a stop limit, but it doesn't matter. The real key ones I think are limit or market. Now, why did I say market? Well, over here in this other little circle, okay, it tells you what is the bid and the ask. If you look at the bid means if you're going to sell it, you can sell it for 315 and 76 cents. And if you're going to buy it, it's 315 and 77 cents. That means it's a 1 penny spread between the buy and the sell. Who keeps that 1 penny? The market makers, the people who process all your orders. They're the ones who keep that, okay? And that's how they make their money. Why do they make only 1 penny? Because there's a ton of volume. Tons and tons of shares of Apple are sold and traded every single day. So it's very low. So I'm just going to say, you know what? Give me the market. When you press go, not the review, when you press buy, it's within seconds, nanoseconds, that you're going to get filled. You're going to get your order, okay? And you'll have 100 shares into your account and you'll lose the money. It'll go. The next thing you got to do is press review order. Now, what I do whenever I do any of these orders, I speak to myself. Sometimes my wife thinks I'm crazy because she hears me talking to myself. And I'll say this. I'm going to buy Apple, AAPL. I'm going to buy 100 shares and I'm going to buy them at the market. And the market is $315.76. I look at the thing, I press the review. When the review comes up, it's going to tell me, wow, that's $35,000. Wait a minute. That's not what I wanted to do. So I'm not going to confirm that. In this case, just for the fun of it, we're going to say, no, we don't want to spend $35,000, 100 shares times $315. That's $31,576. Wow. You know, no, that's too much money. It's too much money. I'm not going to put $30,000 right now. I don't have that kind of, no, I'm not going to do that. So let's look at my second option, okay? And my second option is going to be Zoom. Because we already said, there's something wrong with Twitter, okay? Don't feel too comfortable with Twitter. So what am I going to do? I'm going to go through the same process all over again. The first thing I'm going to do is I'm going to say, okay, I'm going to buy Zoom. By the way, when I was doing this just a moment ago, right now speaking with you guys, before saying Zoom, I almost said Twitter. Can you imagine? But what I've noticed the difference because I got to type in the symbol. The symbol is right here. It's ZM. Okay. And so I'll know if I said Twitter and I can put it and I type in ZM, wait, something's wrong. Okay. So it's so important you talk to yourself because you're doing this mechanically. There's nothing magical about any of this. You just have to go ahead and do it. Okay. So I'm going to buy 100 shares of Zoom. Okay. And what am I going to buy them at? I'm going to choose the market again. Why am I going to choose the market? Because the difference between the buy and the sell, it's not a big deal. And I'm going to say, you know what? I want to get the order right away. I could say I'll do a limit. Why would I say a limit? Because I could buy it at 170 and 75 cents or 170 and 90 cents. I mean, there's 15 cents difference. 15 cents on 100 shares is not a lot of money. And I hope you notice that the price changed a lot between the last time I looked at this, which was maybe, I don't know, 15 minutes ago or something like that. Let me see what it was. It was 168 when I looked at it. And by the time I got to this chart, it was already at 170, okay? So it went up $2. So I don't want to put a limit because if I put a limit, I could maybe not get filled. In other words, maybe I won't get it. So I'm just going to say, give me the market. I know that the difference is 15 cents. I don't care. That's the price. When I hit go, it'll probably get that price. It could move, right? It could move in a minute, but it's not going to move that much. Okay. So that's what we're going to try and do. And so we said that the important thing again, review the order. When you click that, it's going to tell me the order, and then it's going to tell me, wait, 100 shares at $170 a share is basically $17,000. Okay, I can deal with that. I can't deal with $35,000, $17,000. So I'm going to go ahead and click the review, and then I'm going to order it. I'm not showing the order because if I show the order, I may by mistake click it while I'm preparing for the class, and then I'll have some shares that I, right at this moment in time, really don't need. Okay, so let's look at the risk graph. And when I say the risk graph, this is basically what's going to happen with Zoom as we go forward. We're buying it at $171.90, 100 shares, which would be 17,190. That's the order I'm putting in. That's the market order. Let's see what happens. Okay. So the first thing we got to say is, well, we have an unlimited reward on the upside, unlimited because, well, nothing's ever told you there's not infinity, but it can go up and up and up and up and up, right? And my break even is $171.90. I also have, theoretically, an unlimited risk all the way down to zero. And if you don't think that companies go to zero, well, buy Global Crossings, if you can even find it. It doesn't exist anymore, okay? There's been tons and tons of companies that were huge, never impossible to fail, and they're gone, okay? So I don't want to mention them. I don't want to get into them. But, you know, there's always a downside risk when you buy anything. Even at 170, it could go to 130. Now what? What do I do? Okay, so I bought 100 shares. Okay, that feels really cool. I feel very comfortable. I bought 100 shares. What do I do? Because now I bought it, I'm a little bit nervous. Okay, well, there's something called a married put. And a married put is also known as a protective put. I own the stock. I just got through buying it. I'm really excited. Yeah, I got it. Boom. But uh-oh, I'm a little bit nervous. What if it goes against me? I can buy insurance against the possibility of a price decline. What is insurance in this market? It's an option called a put. Because if it goes down, I have the right to put it to somebody at the strike price I chose. So I can buy a put to protect my downside. And this is called a married put because I buy the stock and the put, they're married. It's a protective put. I own a stock and I own the put, which gives me the right to sell the underlying security at the strike price of the put. Okay? So now the question is, okay, I bought the shares. I can buy a put. Which put should I buy? Because there's different kind of prices for puts. Okay? So I have to come to that decision. So the only thing I can really do is look at something called the options chain, okay? And when I look at this option chain, I cut out everything else, and because there's other things in this chain. And I said, well, how far out do I want to go? Because I can say, you know, the further out I go, the more expensive the put will be because I'm buying time. But the closer in I am, it's going to be cheaper, relatively speaking, because I'm not buying time, but I don't give time for the product to move, the price to move, okay? So let's look at what date I chose. I chose June 19th. Why? It's the third Friday of the month. That's when the stocks expire, okay? It gives me 37 days. And I'm looking at the out of the money. What it was called out of the money? Because at the money is at this line here. In the money is here. Why is it in the money? Because there is a value to this put. If I can put it to you at $75, I'm going to make $5 because it's selling at 170. You know, so that's crazy. But at the out of the money, I'm not going to put it to you at 165 because it's now selling. You know, why would I force you to buy it at 165 if in the market is selling at 170? Well, let's just say for the fun of it, I'm going to say, you know what? I can tolerate a $15 drop or a $5 drop or whatever. Let me see, a $10 drop in my price. I'm basically getting it at 170. If it goes to 160, that's it. I'm done. I'm out. Well, what will that cost me? Because I'm going to buy, okay? So notice here they got a bid and an ask. The bid is people wanting selling it. The ask is people buying it, okay? So I could buy the put, which gives me the right to sell it, okay, the asking price. I could buy it at $12.90. That's what it's going to cost me per share. No, excuse me, per contract. Okay. So it's going to cost me times 100 shares. So it's going to be costing me $1,200. All right. So it's going to something I can say, okay, fine. If it goes down, I'm protected to 160. So the asking price is the purchase price because I'm buying a put. Okay. I'm buying the put because if the stock goes down, I want to put it to you. I want to sell it to you because if you're buying it from me, if you know. So if you sold me the put, I'm buying the put, give me the right. Somebody's selling the put, they have the obligation to take my right. I have the right to put it to you. Okay. I want to be very clear. When you're buying a put, you have the right to put it to you. I have the right to sell it to you. It went down, fine. I'm going to make sure, let's say it goes broke. It goes down to $1. I could still sell it at 160 bucks. Well, that's not too bad, right? I mean, I'd save myself an awful lot of money. Can you imagine when this crash happened? Wow, you could have just, made a fortune, okay? If you had puts and everything. Now, the interesting thing, well, I don't want to get into, so I was going to say something I don't want to get into, make it more complicated, but I have here 37 days of protection, okay, for $12.19 per contract, per share. The total contract is going to cost me more. So let's have a look. What do I need to do? And here's where you need to be very, very, very careful. Okay. What we're doing when we do this is what it's going to look like. Okay. We're going to place an order. We have to put in the symbol. We're talking about Zoom. Okay. We think Zoom is really cool. All right. So it's called buy to open. Why? Because I'm opening the contract. I'm saying I will buy this. Once I buy it, I can sell to close the contract, but I'm opening, I'm starting the position. I'm going to buy one contract. One contract will protect 100 shares. Okay, one contract, 100 shares. What am I buying? Notice here, I'm buying a put. I want to be sure I don't want to buy a call. I could do that by mistake. So remember that. And which one did we say we're going to do? Whoops, sorry, went too far. We said we're going to do the 160, okay? That's the one we said we're going to do. All right? So when we say we're going to do the 160, notice it says there strike price 160 and the date is June 19th. I have 37 days in which I can put it to you at 160. It's now going to cost me 171 to buy it. Okay, so I'm not going to put it to you at 160 because I'll lose money. But if the thing goes down to 130, I can force you to buy it. Force you, but just exercise my right. Okay, I have a right to sell it to you. Okay, now the other thing, if you see there, it says, what does it say? It says there's a bid and an ask. The bid is $12.50. The ask is $170. I'm going to put a limit. I'm not going to pay more than that. Why want to put a limit? Because if it goes down, it could go higher. I just don't know. I have no idea what's going to happen. So I'm going to put a limit. I'm going to buy this thing at $12.70. Within seconds, I'll be filled. All right. And it tells me it's going to cost me. And it tells you, it says the estimated amount going out of my money, okay, out of my pocket is $1,270. $12.70 for one share within the contract. There's 100 shares. You multiply that by 100. That's going to cost me 1,200. And I have to speak. If I speak to myself, I'm fine. Then I want to, again, review that order. I want to be sure that I do not make a mistake. And you might sound a little bit foolish talking to yourself. Do not be embarrassed to talk to yourself. You're not going to get an answer. Nobody's going to answer you, but it lets you hear what you're saying, okay? And that's so important. It's so easy to sell to open or to put the word call as compared to put. No, 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 no. You need to be sure you know what you're doing because if you're buying to open a put, buying to open a call, you can do both. Now what? Oh my gosh, you bought the wrong thing. And that has happened. I have sometimes bought something, oh, that's not what I meant to do. And I have to go in right away. And if I bought something I didn't mean to do, I have to go in right away and put sell to close. I have to get rid of it right away. Okay. But I don't want to do this because I want to speak to myself. Okay. So having spoken to myself, here's where we are right now. Well, let's look at the married put financials, okay? I bought 100 shares of Zoom, at $171.90, which means I spent $17,190. I bought one put at a strike price of $160, which gives me the right to put it to you to sell at $160, and that insurance cost me $1,270. So my total investment in this married put, in this protective put, is the sum of the 100 shares plus the put. It's $18,460. So if the stock goes up, okay, if the stock goes up, so let me rephrase it, the stock goes down to 160 or lower, I have the right, I may exercise my right and sell it at 160. So no matter what, I'm going to get 160. So what would my loss be? Well, it's costing me $18,460 to get in, okay? And the most I can get back is 160 times 100, 16,000. I'm going to lose $2,460. Okay, that's the maximum loss I'm going to have, which is not a very happy thing to have, but anyway. So let's have a look and see what this looks like. Okay, everything we want to see what it looks like. So let's have a look at the married put. Okay, and this is the risk graph of the married put. So here we have, we're going to buy the stock at that price. All right, and as we said a moment ago, we have unlimited reward and potentially unlimited loss to zero at that price. At 170. We don't know what's going to happen. We have the right. We're spending $12.70 per share. Okay. So what is my risk per share? It's right there, limited risk at $160. Right here. Okay. If I sell it at 160, over here 160, I'm going to lose $11.90 plus my insurance, which is at $12. So I'm blocking this downside. It's going to stop right there. Okay. Plus my 1270, my risk is limited to that number. Okay. What is my break even? I didn't mean to click it forward, but it did it anyway. Okay. Now I don't have this line. I'm not on this line anymore because all of a sudden I'm over here in this line. My break even is right here. My break even is my cost of my stock plus the cost of my put, my married put. My break even is 184. So if the stock hits 184, I'm breaking even. But I need it to hit 184 to break even, not make a penny. It's got to go to 185 for me to make 40 pennies. It's got to go to 200 for me to make $16. That's interesting. So what can I do? Well, let's have a look 1 second. The cost of the put is $1,270 for 35 days to protect an investment of $17,190. So how can I reduce that cost? Well, hallelujah. I can sell a call. See, I own these shares. If I sell a call, I have an obligation to give my shares to whoever bought the call. They have the right to buy it at the price we agree. Okay, so I could sell a call. And when I sell the call, then this thing becomes what's called a collar. Why is it a collar? Because I have the stock protected by a put with the selling a call to reduce the cost of that insurance of that put. It becomes a collar. Beautiful, gorgeous collar. Why? Well, you got to think of a collar as simultaneously having a protective put and a covered call that we discussed in an earlier webinar. But basically, a covered call is when you own the shares, you can sell a call to bring in cash. Okay. In this case, we're selling a covered call to reduce the cost of the put. So the put costs $12.17 or $1,270, $12.70 per share. Okay. When I sell a call, I'm going to reduce the cost of my put. So let's have a look and see what that is. Let's begin by just looking at again, the risk graph. This is the other side of the graph. Over here, where did my cursor go? There's my cursor. Okay, over here were the puts. I covered them up. Now I open up the call. So, I didn't want too many numbers. Remember I said the break even was 184 something, basically $185. So in this case, for the fun of it, let's look at, these are out of the money. Say over here, out of the money, meaning they have no intrinsic value. By intrinsic value means there's no real equity in them. Nobody is going to buy a call. Nobody's going to buy my shares at $185. It's crazy. Okay, I'd love to sell them at $185, but when I'm, sell the shares, but what did I do? I sold a call, which gives me the obligation to give it to you at 185, but you have the right to buy it at 185. Would you buy it at 185? No, it's at 170. Okay, so there's no real value in there, except you may have an expectation it's going to go up. So you say, you know what? I'll risk it. I think it's going to go up. I'll buy the call. I'm more than happy to get rid of it at 185. Okay, look at it that way, all right? So if you notice, there's a bid and a sell price. A bid and an ask price. Bid is when you go to sell. Ask is when you go to buy. So bid is the selling price. So we're going to sell this call at 1160 a share. Okay, we're going to sell it at 1160 a share. That's what we're going to do. We have 100 shares. We can do one call for the 100 shares. Okay, so now we're going to bring money in to lower the cost of my insurance. Okay, so what does that do? Let's have a look at how we place the order. Again, we want to be sure we put the word Zoom in there, okay? We got to put the word Zoom. If we mess up there, we're in deep trouble, okay? And we got to sell to open. In the case of the put, we want the put, we buy it to open because we want the right. Now we want, what do we want? We want money to come in. So we want money to come in, we're selling. We have an obligation to deliver that stock at what price? At $185, okay? When? By June 19th, 37 days from now. And we got to be sure we put in the word call, okay? Because that's what we're doing. We are selling a call. We're giving somebody else the right to call it away from us. We're giving somebody else the right to exercise their right for me to sell it to them at that price, 185, which, by the way, was the break even before, break even of just the married put, okay? So the married put, now all of a sudden I'm up there, all right? So, well, let's see what else we can look at here, okay? When we look at this, is something else which I found interesting when I looked at this. Look at that. You see the bid and the ask? The bid is 1140, the ask was 1190. That's a 50 cent spread. 50 cents times 100 shares, all of a sudden that starts to sound a little bit interesting, okay? So what can I do with it? So you know what I'm going to do? I'm going to go in between 1140, 1160. I'm going to put a limit. Remember the other one we had market? I'm going to say, no, I'm going to buy it. If it's this price, give it to me. I'll take it, okay? And you see here, it tells them how much money is going to come in. 1160. Now you could say, well, why don't I try 1190? I can't do 1190 because I'm selling. This is the person buying. I have to be over here. But I don't want 1140. Let me try 1160. Okay? I'll review my order. If my order says what I believe it's going to do, I'll place the order. I'll just hit go ahead, buy. Okay? Or in this case, go ahead and sell because we're selling to open. We're selling you the right to make me sell you this product at a lower price. The person who bought it has the right to buy it at 185, 37 days from now. That person believes it's going to go above. I don't know what they believe. Who knows? But that's the price. So let's see what happens. Whoops. Another little thing before I forget. Oh, it didn't show up here. Didn't matter. But the real price when I looked at it turned out to be 1170. Okay. So what happens? How did the caller reduces the cost of my insurance, okay? The cost to buy the put was $1,270. The revenue of selling the call is $1,160. So the net cost of the put is basically $110. What is, sorry, didn't mean for that to move. What is the $110? It is the 1270 minus the 160. It's $110. Wait a moment. I can live with that cost, $110 to protect 17,000. That's like 1%, a little bit less than 1%. I can live with that. Now there is a trade-off to the profit potential. It's capped. Why is it capped? Because the strike price is 185. If this thing goes to 200, the person who bought the call is going to say, Mr. Bull, give me those shares at 185. So I'm capped at that 185. There's always a trade-off. Everything has a yin and a yang, a trade-off, okay? That's very important to understand, that trade-off differential. Very, very important, okay? So what have I done? To protect myself, I spent 1,270. To lower the cost, I sold a call for 1,160. And basically, I have an out-of-pocket of just $110 of a total investment of 17,090. And I feel safe. I can go to bed. I don't have to worry. If the market collapses, I really don't have to worry that much because I have insurance to protect myself. So let's have a look at the risk graph, okay? So here we are. There's the price, 170.90. That's what I could get it at. And as we know, as a stock, it can go all the way down, it can go all the way up. That's what it can do, okay? But we have the 160 put. We paid $12.70. So all of a sudden now, if you wish now, where's my cursor? Here it is. My loss or the price will stop here. This time, boom, I sold it. But what happens to my profit? My profit moved over here. You see, I'm not breaking, because right now this is with nothing, but all of a sudden, hey, I need that other $12, okay? Or $12.70. Now, the other thing I've done, since this cost me $12, okay? And over here, it could go to 185 because that's what I'm saying. I'll sell it at 185, okay? So my money that comes in is 160, all right? So my reward is capped at 185. I can't make any more money than that, all right? So what have I done? I have limited my risk. Limited my risk to what? It's 160, right? Which is $11.90 loss. Where's that? That's the 160 from this price would be an $11.90 loss. Okay, I could lose $11.90, but my total cost to make sure it doesn't get worse, because that's what the insurance. Look, it says a deductible. You have a car accident, you have a deductible. Okay, so the cost of the insurance is $1.10. Where's this $1.10 come from? It's the cost of the put minus over here the money that I got in for the call, 1160. It's 110. 1270 minus 160 is 110. So we got 1190 plus 110. My total maximum loss, if all hell breaks loose, is $13 loss. Okay, so that's not too bad. Okay, I can live with that, right? So where's my break even? Now all of a sudden my break even has moved to 171 plus my insurance, which is $1.10. It's $1.73, $173. So if this thing goes to 185, okay, 185 is the number up here. If it is 185 and I'm forced to sell it at 185, it cost me 173. Well, I've made 12 bucks in 30 days. That's a good return on my investment. But the important thing is it let me sleep at night, because today we're in an extremely volatile market. It's going up and down and up and down and up and down. And if this thing goes down to who knows what, and you think about Zoom, Zoom sells at 1,000, I forgot what the number was, but a ridiculously PE ratio, okay? It makes 9 cents per share, which is meaningless, okay? And now you got Google coming out with their own platform that basically, if you look at it, I mean, it's for free. Zoom is for free, but you're capped at 40 minutes. If you want to have a longer Zoom meeting, you got to pay a certain amount per year. And they're doing very well. Everybody's using Zoom, 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 Zoom. But do you remember the BlackBerry? Everybody had a BlackBerry. They even called them crackberries, and they're gone. So I'm not saying Zoom's going to go down. Believe me, I'm not saying that. I don't want it to go down. But if I buy Zoom, I know I can sleep at night because I know the worst case scenario for me is I could lose $13, which is not nice. But you know what? $13 on what kind of investment? You know, basically, I could lose $13. And what did it cost me? I mean, I can sleep, I can live with that. I can live with a $13 loss. That's the important thing. That's why I call this married puts and a collar. Okay. So the married put is to protect yourself, but sometimes the cost is very high. The cost of puts today, in today's market, in any stock is extremely high. Why? Because of volatility. The market could crash tomorrow, next week. We don't know. It can crash anytime, right? But right now, we don't know what's going to happen with this crazy Wuhan virus or coronavirus or whatever you want to call it, bloody thing. We don't know what's going to happen with it. And since we don't know, we need to have insurance. But insurance costs money. And one way to reduce the cost is to sell a call, make it a collar, but you have to recognize you're limiting your gains. So everything has a yin and a yang. You have to decide what you want to do, what you feel best with, okay? So before we fully end, I just want to once again tell you my disclaimer. We went over at the beginning. I have to go over it again if anybody came in later on. I am not an investment advisor. I'm not an attorney, not a CPA, an accountant, financial advisor, broker, whatever you want to call it. You must agree that you bear all responsibility for your financial, your investment, your tax decisions. You agree that me, Robert Bull, is not and will not be liable for any investment, financial, tax decision that you may make based upon what I presented today. All information was sourced from various publications. In this case, almost all the information I got out of TD Ameritrade. And I believe that information will be accurate and reliable. And I got it this morning, so this is reasonably accurate. The market's closed already. I have no idea what these things ended up, but that doesn't matter. Okay, so I have no claims or representations as to the accuracy. Please consult your attorney, your tax advisor, your accountant, your financial advisor, your broker before you make any decisions. Stocks and options tradings have potential rewards, large rewards. They also have potential risks. Please be aware of the risks and be willing to accept them in order to invest in stock and option trades. By the way, covered calls and married puts and covered calls are the simplest options to get approval for. Okay, so please do not trade that money that you cannot afford. This is not an offer. I'm not suggesting that you look at Twitter or any of these things. I just chose 3 because I just felt like choosing those 3. Okay. So there's not an offer or a suggestion or anything to buy, sell. It's not a recommendation of a stock or anything like that at all. So I want to thank everybody for being on this webinar. Thank you very much. And if you have any questions, just send me an email, rbull.miamirotary@gmail.com. I have a Facebook page. You can look me up at rbull or at facebook.com, Fespa Financial, or you can look at my YouTube channel. This will be up later on today. My YouTube channel is Fespa. If you look at Fespa, there's thousands of other Fespas. The short URL is, or easy way to get there, says shorturl.at/little b big D G M T. That means capital BGMT. I'll send this to you. I really appreciate you being here. Thank you very much. And the next webinar I'll be dealing with will be next week this time. And it's going to be more focused on Rotary and on how to maximize our Facebook likes, our Facebook pages, so we can get more and more people seeing what the club is doing. This was valid not only for our Rotary Club, but if you have a Facebook professional page, I'll be giving you hints and ideas how you can expand the scope, the reach of your professional pages on Facebook. This is not for your private pages, your personal pages. It's got nothing to do with this. This is totally about your business page, okay? And there's plenty of ways you can do that. If you have some people that already like your page, well, guess what? We can really expand this. So that's what we're going to be dealing with. So I'm just going to say right now, thank you very much for being in this webinar. It's been a pleasure having you here. Please be safe, be healthy. Goodbye. Thank you very much.